Well, welcome to the Genus quarterly video. It's October, barely, 2017, and we haven't had the September-October problems that often come. Our last video, you nervously said that probably wouldn't happen this year, but there still is a lot of concern on part of our clients, Wayne, that the markets have gone so far in the last 5 or 6 years, and we're seeing evidence of U.S. investors piling into the market, not to '08 levels, but just getting nervous at the odd lotter, or the retail investors getting in at the wrong time again. So we don't think it's the wrong time, but so are the markets overvalued? I'll just put that out there.
Well, they're moving to become a little more expensive. The U.S. market on a forward basis is about 18 times PE. Canada's around 16. So that's not excessive when inflation is very low at 1%. And rates are very low. So compared to bonds, stocks are still a very good deal.
So just let's talk about P's for a second. So in 2000, the tech bubble burst. They were more like 35 or something?
Yeah, much higher.
So that was an extreme valuation. They weren't so high in '08, but that was a financial crisis.
And there's been a long-term kind of rule of 20 where you take the current P plus the inflation rate and you get equals 20. So I'm saying we still have some slack there.
So that's a great rule, guys. The PE plus inflation rate equals 20. So we're
So but valuations is the only thing that drives the markets as well. If you look at the overall markets right now, they're being driven still by liquidity. There's ample liquidity out there.
Right.
Growth is going to accelerate. We're getting into a synchronized global late cycle recovery, or growth period, if you will. And so we're going to have stronger growth next year, we believe. Economy's doing fine. Valuations are a little higher than average, I would say. And there's
earnings coming through.
Earnings are coming through.
80%
of earnings this quarter so far have beat estimates.
Right.
And so there's also ample liquidity. So this is kind of, so we have decent growth, low inflation, ample liquidity. I wouldn't get too concerned about the markets just yet, but things can go bump the night, of course. There's Korea and everything else out there. Right. So,
thanks for reminding us.
But we are in the beginning of the tightening cycle from central banks, but the U.S. has tightened somewhat. Europe's about to start, but still, it's not really tight monetary policy yet. So I don't think I wouldn't blow any whistles because of that, but it is coming. Next year, mid-year, third quarter of next year. We should have some concerns if the Fed and other central banks keep on tightening.
So a question I've gotten a couple of times recently is, does Genus incorporate things like NAFTA falling apart?
Well, NAFTA falling apart, we don't think it's going to fall apart. The signals we've seen so far is there might be a bilateral deal with Canada and the U.S., and maybe that'll force Mexico. So I don't think Canada's been essentially a big winner from NAFTA, at least as much as Mexico's been the big winner from NAFTA. So I think, if anything, we'll get a bilateral deal with Canada and the U.S.
And what I say is even if something negative happens one day, it's kind of like Brexit. The market is not very good at analyzing long-term issues.
Yeah, the market has a horizon of about 6 months, and if it can't analyze something or discount it, it just moves on. Right. And so the Korea thing is going to be going on for years, I believe, and it just moved on, and away we go.
So Wayne, last video we talked about moving money out of the U.S. into Europe. That's turned out to be a good trade. We did about 5% of the portfolio with that. And mainly it's been a good trade because of the currency. The U.S. dollar's gone down, the euro's gone up. Valuations are cheaper in Europe. Yeah. How do we feel about that trade now?
We still think it's the place. We prefer that over the U.S. It's better valuations. Also, with the French election, we think there's going to be more of a move towards deregulation. That could be a good thing for valuations as well in Europe and growth longer term. The center seems to be holding there.
Despite Austria.
Despite Austria, and I think it's basically and also they're behind in the business cycle. Right. So they still have a lot of growth there in terms of the economy improving.
So we've touched on the stock market, but we need to talk about the interest rates a little bit. They've gone up. Bond rates are higher, quite a bit higher. What do we see there now?
I think bond rates, 10-year rates in the U.S. can go higher. It looks like they're breaking out right now. They're about 244, 245. They could go to 275, maybe 3%, I think. I think Canada will lag. I think Canadian rates will go up, but not as fast because of what's going on. I think the housing market in Canada is slowing down. If the global growth takes place next year, that could be good for Canada, and maybe could give our rates a boost or our currency a boost. But right now, I think Canada seems to be taking a bit of a pause after a strong year last year, driven by the housing boom, if you will.
So the portfolios are still overweight cash versus bonds and full weight in equities. And it's really, we've done well, I know, against absolute return and relative returns. Has been a good year.
And within our equities, we're leaning more towards the late cycle stocks that are more economic sensitive.
Right.
We're overweight financials, technology, consumer discretionary, and some industrials. We're underweight all the interest-sensitive ones, telecom, utilities, and consumer staple companies. So we're geared in the equity side for this late cycle.
So how does that jive with our high dividend fund when those defensive sectors are the high dividend sectors?
Well, in this kind of environment, we expect the dividend strategy to lag a bit. On the other hand, there's a lot of good value in that portfolio and dividend yields, which will always help. There's also a smaller cap. So if into next year, if the economy keeps chugging along and we go into the late end of the cycle, we anticipate that value will come back. The dividend strategy is a deep value strategy, and smaller caps will come back. A lot of the markets this year has been driven by bigger cap growth companies. So, and because of that, even though it tends to lean more towards the stable companies, we think the dividend strategy will hold its own. It has done so in the past.
And European stocks yield a lot more than U.S.
Exactly. Yeah.
But just to clarify what you said you're overweight Europe versus the U.S. That's against a policy. Our absolute weights in the U.S. are higher than Europe.
Yes.
Because of what America is.
Exactly.
Well, thanks for listening. We look forward to talking to you. Give us a call.